Hello, everyone. And today we need to talk about something that could detonate the global economy overnight: Iran. Because if this escalates, we are not talking about headlines. We are talking about oil shock, inflation shock, market shock, and geopolitical realignment happening in real time. And the most dangerous part? The pieces are already moving. Let's be clear. This isn't about diplomacy anymore. This is about position. Over the past few weeks, we've seen three critical signals: carrier movements, expanded sanctions, regime change rhetoric. That combination is not accidental. When you move the USS Gerald Ford, the most powerful aircraft carrier in the world, from one theater to another, that is not a routine exercise. You do not reposition strike groups for press releases. You do it for leverage, or you do it for preparation. And when that repositioning happens, while sanctions tighten and the president openly talks about regime change, that's escalation language. And markets are not pricing it properly. Let's break this down calmly. Iran produces roughly 3.3 million barrels per day. That may not sound massive compared to Saudi Arabia or Russia, but here's what matters. Iranian oil is deeply embedded in Asian supply chains. China alone imports around 1.5 million barrels per day from Iran, much of it discounted and routed through shadow fleets. That discounted supply is not just energy, it's leverage. It keeps Chinese manufacturing competitive, it offsets Western sanctions, it stabilizes Beijing's industrial cost structure. Remove that, you are not just hurting Tehran, you are disrupting Asia's pricing equilibrium, and that ripples outward. Now layer on the Strait of Hormuz. This is not a side issue. Approximately 20% of global oil consumption flows through that narrow passage. If that choke point is even partially disrupted, insurance premiums spike, shipping costs spike, oil futures spikes, volatility spikes. It does not take a full blockade, it takes uncertainty. Markets move on probability, not certainty. And right now the probability of escalation is rising. Now let's talk consequences. If US strikes target Iranian production infrastructure, oil could easily jump 20 to 30% within weeks, even in a so-called global glut, because markets are forward-looking. And forward-looking markets price fear first. Higher oil means higher transportation costs, higher manufacturing costs, higher food costs, higher energy bills, higher inflation expectations. And here's where it gets dangerous. Inflation is already sticky. Interest rates are already elevated. Consumer credit stress is already building. Add an oil shock, you have a stagflation cocktail. And the Federal Reserve will be boxed in. Cut rates and you fuel inflation. Hold rates and you crush growth. Either way, volatility. Now let's talk about China. Beijing will not sit quietly if its discounted oil pipeline collapses. Not because of ideology, because of economics. China's manufacturing machine depends on stable input costs. Energy stability is strategic stability. And if the US destabilizes a key supplier, Beijing has choices: diplomatic pressure, increased BRICS alignment, accelerated de-dollarization, expanded energy deals with Russia. Every escalation accelerates fragmentation, and fragmentation weakens global liquidity, which markets are already struggling with. Now let's shift to North America, because something else is happening simultaneously. Canada is exploring deeper alignment with Chinese EV manufacturers, joint ventures, manufacturing partnerships, technology integration. If that materializes at scale, you have Chinese expertise, Canadian industrial capacity, North American proximity. That combination could destabilize US automakers. Because if tariffs shift, or if political leverage forces realignment, American manufacturers lose pricing power, and pricing power is survival. We are entering an era where geopolitical moves directly translate into industrial consequences. This is not abstract, it's structural. Now here's the pattern. Sanctions tighten, oil revenue squeezed, currency pressured, domestic instability encouraged. We've seen this model before. Economic warfare precedes kinetic escalation, and we are watching the early stages. If escalation stops, markets stabilize. If escalation accelerates, you get oil spike, inflation spike, equity volatility, and dollar turbulence. And remember, US debt issuance is already extreme. Higher oil, higher inflation, higher yields, higher borrowing costs. That squeezes everything: big tech, small business, real estate, consumers. This is not isolated, it's systemic. Now here's the critical question. Is this posturing or positioning? Markets are behaving as if it's posturing, but troop movements and sanctions tell a different story. And if investors wait for confirmation, it will already be priced in. That's how shocks work. They do not announce themselves politely. Before we move to part 2, where we break down Russia, the dollar system, and the deeper geopolitical shift, I need you to do something. If you value clear analysis without emotional noise, hit subscribe, because the next 12 months will redefine global power alignment, and most people will not understand it until it's too late. We've talked about Iran, we've talked about oil. Now we need to talk about something even bigger, the dollar system. Because while the Middle East heats up, something very quiet but very powerful is shifting underneath it all: Russia. And the rumor that Moscow might return to the dollar system. Let's be precise. There are headlines floating around suggesting that Russia could re-engage in deeper economic cooperation with the United States, possibly even resume dollar-based settlements in energy. On the surface, that sounds dramatic. But when you peel back the layers, the story is far more strategic. First, understand this. Transactions in dollars are not the same thing as holding dollars. That distinction is critical. Russia may transact in dollars again at some point. That's not shocking. The dollar is still the dominant trade currency. But recycling those dollars back into U.S. treasuries, into U.S. assets, that's an entirely different decision. And it's one that carries enormous risk for Moscow. Over $200 billion of Russian assets were frozen after sanctions. Frozen. Not temporarily restricted. Frozen. And some Western policymakers have openly discussed confiscation. If you are sitting in Moscow, what lesson do you take from that? You do not rebuild your national reserves in the same system that just weaponized them. Before the Ukraine conflict even escalated, Russia had already started de-dollarizing. In 2021, Moscow cut US dollar holdings dramatically from its sovereign wealth fund. It shifted reserves into gold, Chinese renminbi, euros, at the time, non-Western instruments. That was before asset freezes. That was before confiscation discussions. That was before the escalation. In hindsight, it was strategic foresight. Now look at the results. Gold has surged over the past few years. Russia's gold reserves have exploded in value. Gold now accounts for a massive portion of Russia's national reserves. That move alone offset much of the financial damage from sanctions. When you see that kind of outcome, you don't reverse course. You double down. Now here's where the dollar system enters a new phase. If Russia resumes trade with the US, and eventually it will in some form, those transactions may be dollar-denominated. But what happens after the dollars are earned? That's the key. Moscow can 1. Immediately convert dollars into gold. 2. Convert into yuan. 3. Route into non-US bonds. 4. Use swap lines within BRICS. They can transact in dollars without holding them. And that's the quiet evolution of de-dollarization. Not dramatic overnight abandonment, but transactional usage without structural reliance. That weakens dollar recycling. And dollar recycling is what funds U.S. deficits. If the U.S. escalates with Iran, oil spikes, China is pressured, Russia gains leverage as an alternative energy supplier, and BRICS alignment tightens. The geopolitical chessboard shifts, because energy alignment becomes political alignment, and political alignment becomes financial alignment. That's how multipolar systems evolve, not through speeches, through incentives. Now let's connect this back to markets. If oil spikes and global fragmentation increases, inflation stays elevated, central banks stay defensive, bond yields stay structurally higher, equity volatility increases. Meanwhile, if global trade becomes more regionalized and less dollar-centric, demand for U.S. debt weakens at the margin. Funding costs creep higher. Liquidity tightens. This doesn't mean the dollar collapses tomorrow. It means the margin of safety shrinks, and markets operate on margins. Now here's the irony. The U.S. still exports to Russia in certain categories. Despite sanctions, trade channels find ways. Because supply chains do not vanish, they reroute. Sanctions create friction, not total elimination. So limited economic engagement is already happening. But strategic reserve trust? That's a different animal. Trust, once broken at sovereign level, is not rebuilt easily. Now layer this over Iran. If escalation happens and energy markets destabilize, Russia becomes more strategically valuable. China leans deeper into Russian supply. Gold strengthens. The dollar faces pressure from both inflation and geopolitical fragmentation. And the U.S. must fund ever larger deficits at higher yields. That's a structural pressure system. And here's what most analysts miss. This isn't about one war or one sanction package. It's about system fatigue. The global system built post-1990 assumed dollar dominance, energy stability, financial integration, predictable trade. We are now operating in weaponized finance, fragmented trade blocs, strategic energy realignment, politicized supply chains. That shift doesn't explode overnight. it compounds, and compounding is powerful. Now ask yourself, if Russia were to rebuild reserves today, where would it put them? U.S. treasuries or physical gold? U.S. equities or bilateral energy partnerships? The answer is obvious, and that tells you where the long-term momentum lies. Now bring this back to the American investor. If oil spikes, inflation sticks, and yields stay elevated, growth multiples compress, debt-heavy sectors struggle, rate-sensitive assets wobble. Meanwhile, energy volatility increases, hard assets regain relevance, geopolitical hedges strengthen. The market environment shifts from growth euphoria to risk management discipline. That transition is never smooth. Let's be clear. Escalation with Iran is not guaranteed. Russia returning fully to the dollar system is unlikely. But the trajectory is what matters. And the trajectory is fragmentation. Energy fragmentation, financial fragmentation, political fragmentation. And markets must adapt. We are entering a decade where geopolitics and markets are inseparable. You cannot analyze equities without analyzing energy. You cannot analyze bonds without analyzing sanctions. You cannot analyze currencies without analyzing power blocks. This is not 2015. This is structural transition. And structural transitions create volatility. Volatility creates opportunity, but only for those who see it early. If you value analysis that connects geopolitics to capital markets without emotional hype, make sure you're subscribed, because we are tracking the fault lines before they crack. And in this environment, being early is survival. Stay sharp, stay strategic, and I'll see you in the next one.